Hi, good afternoon, everyone. Thank you so much for joining us today. This is I promise it's going to be quite an interesting session as we're going to take the LP view on the evolving landscape of private market in Asia. And as we explore the key considerations in constructing a resilient Asia-focused portfolios, which includes the impact of geopolitics, manager quality, and liquid visibility. It's And before we dive into this discussion, I would like to invite our panelists to give a quick introduction about themselves.
Sure, happy to start. Hi, everyone. My name is Amanda. I am a principal with Harvest Partners based out of their Hong Kong office. I help oversee our primary investments in the region. We are a global asset allocator. We have about 170 billion in AUM, focused primarily on private equity buyout, venture across primary, secondary co-investments. We also have a growing infrastructure real asset business along with credit as well. We've been in the region for 30 years. We're actually celebrating our 30-year anniversary of our Hong Kong office, so have certainly been in the region for a long time. Looking forward to the discussion today.
Hi, everyone. My name is Randy. I'm with Stepstone Group. Stepstone is a global private markets firm. We operate across all four alternatives asset classes, including private equity, private credit, real estate, and infrastructure. Globally, we manage about 220 billion of AUM across 27 offices. So I help oversee Stepstone's investment activities across the Asia Pacific region, which includes fund investments, co-investments, and secondaries. And I've been at Stepstone for 10 years.
Hi, everyone. I'm Pamela. I'm with Morgan Stanley with our private equity solutions team based in Hong Kong, covering Asia. The role in Asia is twofold. One is Asian investments across funds, secondaries, co-investments. The other angle is working with Asian clients to provide them global private equity exposure. I also sit on the global IC, so I know this panel is about Asia, but to the extent there's questions on global, happy to address those as well.
Hello, everyone. I'm Jonathan. I'm with Allen Street in Hong Kong, our Hong Kong office, and good to be here and seeing some familiar faces. So Allen Street Partners, we are a private market investor, one of the early pioneer in the industry. Currently, we are managing about 70 billion across different strategies. That includes, of course, fund investments across primary, co-investment, secondary. We also have private credit investment arm, and also we also look at some of the direct venture growth investments as well. We have been investing in Asia for about 2 decades now, and I'm part of the team who actually cover the Asia investment activities across the primary, co-investment, and secondary.
Great. Thank you. Thank you so much for that. So, Pamela, I'd like to start off with you. Asia portfolios have, historically built around diversification around China, India, Southeast Asia, Japan, and Korea. But these markets increasingly behave very differently in terms of risks, liquidity, and exit dynamics. So, in this case, is Asia diversification still meaningful as a portfolio construction framework, or are the LPs kind of treating each and every one of these markets as separate allocation decisions?
Yeah, maybe let me start from 10,000 feet, global first. So as investors think about building out their global private equity portfolios, you're really trading off these are long-term investments, 10-year fund terms. So you're really trading off that illiquidity with the potential for alpha. And then thinking about it from a global private equity perspective, so obviously the industry in the US started in the US. So that's the longest history, the deepest market in terms of the consistency of returns and the alpha. It's been pretty strong. I think there's also Europe, which I would say is the second oldest region. Again, it's a somewhat deeper market, but it's also many different countries, cultures, and there you do have some specialists, whether it's pan-European, country-specific, and sector specialists across the regions. As we think about Asia, so it's not that new. I would say it's 20, 30 years in the making. If you think about the Asian markets, I think one unique feature is it's many different cultures, many different countries, many different jurisdictions. So I think all of us on the panel keeping track of what's going on in every country. We were talking a bit about this before the panel, but if you think about politics, if you think about culture, if you think about everything going on in every country, there's always a lot going on. And I think the reality of it as a global investor investing in private equity, when you look to Asia, you're really thinking about it from a risk return perspective. And you're also thinking about, Asia generally, these economies are newer, faster growing, they're less efficient, they're less established. So there's a lot of potential that Asia private equity holds. And then as you drill down to the country level, the way we think about it in essence is, of course, you need to be keeping on top of the politics, the trends in each market. We also think about it from a capital supply demand perspective. So in some ways you can say we're a bit contrarian, but I always like to point to India back a decade ago. Nobody was really investing in India. We pulled the trigger on something in India that played out very, very well. If you think back 10 years ago, China was, most of the market, frankly, doing very, very well. But if you look right now, the tables have sort of turned. There is interest coming back to China, but it's not the same interest as a decade ago. But that also is the opportunity potentially as well. So when we're thinking about these markets, I would say, you do need to make sure that you're consistent in terms of investing and tracking these markets. But there will be ebbs and flows in terms of capital flows and trends, and then that's what keeps it interesting.
So just bearing in mind, all the points that you touched upon and the ebbs and flows, when you look at the liquidity slowdown, and Jonathan, and it'll be great if you could take this, has that liquidity slowdown changed how LPs are then pacing commitments to the region?
Yeah, I think the definitely that has impacted LP decision for sure, right? So I mean, different LP has different dynamic within their organization, but for sure there's some changes in terms of how they are pacing commitment, especially the LPs who have certain funding requirements and obligations. And I don't think it's just towards Asia, but be it between say bond versus equity, within equity, between private versus public, within private Asia versus US and Europe. And even within Asia, there are certain markets that have better liquidity versus some markets that have weaker liquidity. So the allocation within Asia itself has changes as well. I think to what Pamela was sharing earlier, I think Adam Street started about 50 plus years ago. So US private equity probably have 56 years of history. Asia, maybe 20, 30. Of course, it's a very different kind of a market development and dynamic. So naturally, you shouldn't be expecting the same kind of liquidity profile that you see in the US in Asia. And I think probably that's where I guess some of the attraction and return potential for Asia as well, because of inefficiency. That's where I guess private equity could really generate better returns, and people come to Asia for that. And so I think, of course, that is what has happening to your question in terms of LP changing their commitment and pacing towards Asia. But I think the question that we should think about is, should that be the case in terms of changing the pacing because of, say, weaker or slower liquidity environment? Of course, if individual LPs have certain needs, of course, they should change it. But for LPs who have constructed the portfolio with very proper guidelines in terms of thinking of profile liquidity, profile returns that suits their organization need, then I think there shouldn't be a change of that, right? Because I think to our clients, we have always said that I think consistency of deployment and pacing into the market is quite important than trying to time the market. I think each of us here have done investments. I think while we try to time the investments, it usually don't do as well as consistent deployment. So I think what we tell our clients is consistent deployment. And what we do here is we try to help you outperform when the vintages are better. That will offset some of the weaker vintages in the consistent deployment kind of cycle.
But at the same time, Amanda, if you could take this, are you seeing, are LPs kind of becoming more comfortable running more concentrated exposures in specific markets or themes? And if so, what are the trade-offs?
So I actually agree with a lot of what Jonathan and Pam just said in terms of just staying consistent, persistent in the market, and of course the diversification approach for this region. And I just want to echo that. I think if you look at Asia, the opportunity set is extremely diverse. Each market follows different economic cycle. Private equity as an asset class is at different evolution stages for these markets. So I think and if you look at just the pool of GPs that we select from, it's hard to pinpoint the managers that have actually raised high single digit fund series, right? So let alone the double digit that you see in developed market like Europe and US. So from that standpoint, it is hard to specifically concentrate in sort of said manager. I think how we look at the opportunity set in Asia from a portfolio construction standpoint is that we're increasingly focusing on identifying the mega trends in the market and having a forward macro overlay on how we think the markets will play out. And once we distill those mega trends, we work very, very hard to then find the GPs that then are targeting those opportunity set, and we concentrate in those managers where we can in terms of maximizing our allocation and so forth. But I think there needs to be a level of diversification at the portfolio build from the onset before you start thinking about some of the concentration levers.
So there's an interesting point on the managers that you touched on, and I'd like to get back to that in a bit. But just before that, Randy, when we've heard different aspects of the whole portfolio construction of Asia, but if you were to look back at the evolution of Asia in the entire scheme of things, what's changed? What is changing? And what can be expected then?
Yeah, I mean, I think if we look back 10, 15 years ago, Asia was essentially synonymous with China, right? When you're talking with investors and LPs about Asia, they're essentially referring to China plus, maybe a bit here and there in Korea, Japan, Australia, India, Southeast Asia, but it's really a China play. And I think the biggest trend over the past 10 to 15 years is people are not equating Asia with China anymore. The region has become much more diversified from a portfolio construction standpoint, for better or for worse. Obviously, China has gone through a confluence of challenges over the past, really since COVID. And I think other markets within Asia have become net beneficiaries of that kind of capital rotation or capital flows in general. I think, from our perspective, it's really important not to consider Asia as one homogenous market. It's really a combination of very different markets with very different risk profiles and opportunities. So we do think that diversification is critically important, especially if you take the 10,000-foot view. Clearly, U.S. and China are decoupling. The question isn't if, it's when and how fast. And I think in this new world order that we're living in, there are real benefits of having that geographic diversification as markets become less correlated with one another. The last thing I would say is that we don't really take we have top-down kind of thematics that we focus on, but it's really a bottoms-up exercise. Every new investment or every net new relationship that we build in Asia has to stand on its own 2 feet. And they're not necessarily competing with other Asian opportunities. They're competing with the global opportunity set. And so it has to be able to stand on its own. And that's really how we think about kind of portfolio construction.
So diversification is something that's been common in everything you guys have said. But, if you were to look at again, the portfolio construction decision and under the real world constraints, what really sits on top of it all? Would that still be diversification? Because there's also liquid visibility, manager quality, which is again something you guys touched on, or the exit optionality. So in terms of priority, where does one stand?
I can take that one. So I would separate it into 2 points or 2 decisions. One is a portfolio construction decision. The other is a manager selection decision. So in terms of manager selection, as Randy said, each fund or each co-investment, each secondary has to stand on its 2 feet. So we're evaluating all of these considerations when it comes to manager selection. So we're looking at, what's the quality of the manager, what does their past track record look like, what's their technical right to succeed in terms of the team members' backgrounds, how do they think about exits. So these are things that we look at, consistently. I wouldn't say that you weight one of them more than another, but we take a look at, all of these characteristics and, as a package, is it an interesting proposition? As you think about portfolio construction, I think Jonathan touched on this briefly earlier, but then it really depends on each client's considerations. So for example, a lot of clients right now are complaining that they haven't seen distributions. I wanted to emphasize this is not just an Asia-specific problem. This is a global problem. So I think there's been a huge run-up in terms of fundraising in private equity. If you look at the absolute distribution amounts, it's actually on par with the peak years, which I would say was around 2021, 22, but it's just that the NAV has grown so significantly that it looks small. But in reality, the exit markets have slowed. It's been a few bumpy years for IPO, M&A. I think a lot of it is at the larger end of the market. Once you have a large company, who do you sell on to? How do you IPO that company? Whereas I think for a lot of what we're doing globally, it's more lower mid-market focused. We're actually seeing more consistent DPI in that space. I think another feature is, especially as we think about Asia, so Asia being newer, less experienced managers, exit windows in each market are in different places. So in Asia, I think because it's been a new market, more investors have been focused at the front end in terms of investing in funds, investing in deals, versus managing exits at the back end. But I think the industry has been going through an evolution where everybody's become a lot more aware that they do need to deliver the returns, the distributions. So I think the good news for Asia is going forward, GPs being much more aware that they do need to deliver distributions. Also, the exit markets are constantly evolving. So we're seeing, good progress in terms of a lot of the regional IPO markets, M&A markets becoming more active. So as a result, distributions, I think, will improve over time. But it's also the onus on everybody to make sure that we're focused on distributions up front.
And if I could just comment a little bit in around sort of the portfolio construction aspect, I think from a primary lens, so committing to a new funds, I think there is a healthy debate around sort of the weighting between venture end growth versus buyout, right? Because I think if you look at the data pre-2021, about 2/3 of the deals in Asia, and that's a lot is driven by China, were venture/minority, which obviously lends itself to a longer holding period given just the asset class. And that sort of stat has really flipped on its head and sort of been 2/3 buyouts and 1/3 venture in the last couple of years. It's kind of closed the gap a little bit in the last 12, 24 months, around 50-50. Now, who's who said that it will go all the way back to what it was pre-2021, but absent of massive changes in China, the opportunity set there, I think, you look at India and you look at Japan and some of these other markets that have really stepped up the market share and the buyouts that you're seeing there. I do think, there is a natural change to the construction of the portfolio that should lend itself to a quicker pace in distribution. And then I would just also echo from the GP selection standpoint, I think, if a GP does not have a clear point of view on liquidity and how they will create that, maybe with CVs or secondary, maybe with interim dividends or recap, I think it is, it's a bit hard to hang on the old idea of if we build a great company, the exit and buyer will come, because I don't think we're in that era anymore.
Sure. So, in addition to the visibility and liquidity, and I think I'd like everyone's take on this. So, what exactly are you guys looking for in a good manager? What separates a truly institutional Asia GP from, say, a manager who may have simply benefited from a strong fundraising cycle? Amanda, would you like to start, and then
Sure. Look, I think if there's the front end and the back end, right? To what Pam had mentioned, I think it comes down to first principle. the competitive advantage of this manager. And I think what I personally always go back to is, where is the sourcing advantage? Why does the best company, the best founder want to work with you? How do you find them to persuade them to take your capital and your partnership over everybody else? I think understanding whether or not that is systematic, whether or not there is a real framework around it, so that you get to the idea of repeatability is very important. But again, to what I said earlier, the view on exit, whether or not you generate exit events or optionality for your LP, is so incredibly important in this current cycle, that if a manager just doesn't have a point of view, it just would be, a very difficult conversation.
What's your take on that?
Yeah, I mean, I think what separates a great manager from a good manager is their ability to generate returns across cycles, across economic cycles. I think you really have to unpack their prior performance. I think the overall trend in Asia has been returns are becoming less driven by financial engineering, i.e., leverage or multiple expansion, and more by underlying operational value add. And so you really have to ask the question, are these GPs, particularly in buyouts, controlled buyouts, right? Are these GPs actually adding value?
Mm-hmm.
Or are they just momentum investors? And it's over the past 5 years, it's become very evident which managers have benefited from market beta versus the managers that have benefited from their own operational expertise. And so when we look at new fund commitments and new GP relationships, we spend a lot of time just understanding their playbook as it relates to value creation, whether they've done it before and whether they've been consistently successful.
Sure. So, interestingly, so selectivity has been the theme dominating the private market since, I think more so since last year, when we talked about concentration in certain funds, certain managers. So if the differentiation between managers is widening, does that actually strengthen the case for concentration in, say, a smaller number of GPs, or would it make the portfolio construction more complex as opposed to it being selective? So, Pamela, Jonathan,
I'm happy to cover that
Yeah.
question. So I think everybody's alluded to it, but then there's market beta. So during when times are good, it looks very easy to deliver returns. But the true test of a good manager is someone who can invest when the cycle is not in your favor. So that points to how you're sourcing, how you're creating value in the companies, how you're managing exits. The challenge in Asia is because we've only seen 2 or 3 decades of private equity, and the cycles have been very different. As I was saying earlier, India 10 years ago very different from India today. China 10 years ago very different from China today. So the cycles are, you can say, the noise and the signal. So hence, really trying to go back to first principles, as Amanda was saying, really thinking about the building blocks of what makes a good deal. So as a result, do you concentrate? Do you not concentrate? I think it's about the manager quality in each market. I think the interesting thing right now is because as the markets are changing, a lot of GPs, we're seeing them, refine their strategies, think about what really works, irrespective of the market cycles. So I think we're in a period where I hope to see a lot of managers who are doing interesting things. They capturing the current market opportunity. And of course, if you have a manager who's doing everything right and able to capture the market tailwinds of the time, you have the recipe for a very strong performing fund. So what I like about Asia is the growth and the inefficiency. So if you can navigate within the inefficiency, improve efficiency within a company, and you can also capture that growth, then that can lead to very, very compelling returns.
Thanks.
Yeah, I think concentration and selectivity may not be mutually exclusive. I think one is around portfolio construction, one is around manager selection, right? Naturally, I guess you can be selective in terms of manager selection, and everyone would try to select the best possible managers. And that's probably why you see, I guess, some of the better performing, more established manager became larger as more LPs concentrate capital into a select manager. But I guess from a portfolio construction perspective, I think concentration might be something that's a bit harder to do. At least from a fund investment perspective. Of course, you are doing direct investment, you construct portfolio companies. Naturally, you have certain view on certain companies, you have built conviction. So interestingly, we actually had a discussion, I think our usual strategy discussion every year. And at the start of this year, there was an interesting question that was posed to the team. And basically, it was around whether you should have a concentration within a portfolio so that it could generate alpha, like concentrate around your top tier manager, for instance, so that you can generate alpha from the fund investment perspective. And it was a survey, and actually the results were pretty interesting. So I would say the younger or newer entrant to the market within the team would say that yes, we should concentrate on the best manager to deliver the alpha. Whereas some of the senior members on the team actually have a different view to say that actually no, because in Adam Street we have an equal buy kind of philosophy, which basically say within a portfolio, let's say of 10 managers, you would give each of them about the same kind of capital versus say one like 2 times of the other. And the reason behind that is because when you look at the fund, while it looks like the fund manager is a top tier manager because they have performed very well in the past vintages, but the question is when you're looking at the current fund, most of the time the variables will have changed. For example, the GP could have doubled the fund size. The team member who have delivered the returns who have left. So while it looks good on the paper, it's very hard to objectively to draw the line to say that yes, this is a top tier manager, and so we should concentrate on it, right? So I think because of that difficulty in terms of being objectively determining which is the top tier manager, it becomes harder to say let's do 3 top tier managers versus let's find 10 that are good enough that hopefully out of the 10, 5 of them will become top tier managers. So I think that's why I think to your question, while theoretically it seems better to concentrate, in reality it becomes more difficult to execute it. So I guess that's kind of like probably more food for thought for the audience.
Also, you don't know who's a top tier manager until the fund is done 10 years later.
I was smiling as well because I was thinking if you had run that survey at HarborVest, we probably have the same outcome, right? Because the seniors are all the ones that have the scar tissue and sort of bearing the track record. So
there's an interesting question from the audience. Mid-market GPs or large cap GPs, how do you think about that? How does that kind of play out, from all the questions that we've talked about, and even when you look at it from a portfolio construction point of view? Randy,
Randy, go for it.
Yeah.
Sure. So the way we think about it is mid-market versus large cap. They're very different types of exposures. For example, like large cap GPs are highly indexed to the IPO markets, to public and capital markets, because most of their companies are relying on IPOs as exits. Whereas for the most part, I think mid-market GPs, when we look at their underlying portfolios, because they're smaller by nature, there generally tends to be a bit more exit optionality. So I think it's important to have both in a Asia private equity portfolio. In terms of how much, I mean, it really depends on what your risk tolerance is. I do think that based on our empirical data, we have found that over the last 15 to 20 years, small mid-cap GPs in Asia have outperformed the large cap pan-Asia GPs by a pretty wide margin. But the trade-off is that the return dispersion for small mid-cap managers is also very, very wide, which I think highlights the essence of manager selection, because there are a lot of pitfalls when you're looking to select small mid-cap managers. Like Amanda mentioned, a lot of them are raising for second, third time funds. They don't have the scar tissue. They don't have the lessons learned like the KKRs and the Blackstones of the world. And so you are taking that additional risk, and hopefully you compensate that risk with outsized returns. But it's always kind of a tricky game that we're trying to kind of balance between these two subsets of or these two cohorts of exposures.
But would that be a blanket opinion, or would that differ from country to country in the region?
I actually think so. Just from a global standpoint, I just came back from our global AGM that was held in Boston, and I think even folks that are trying to unpack and unlock the U.S. and European markets are also increasingly looking at small mid market, because that is where you're seeing the outperformance. And some of Randy, what you talked about in terms of indexing to the public market, you get less of that at the smaller end, just because there's more optionality in how you exit. But I think more importantly is on the buy. On the mid-market side, on the smaller assets, you get things at a far more attractive pricing that's far more proprietary driven than the auctions that you're seeing. So I think in Asia, we've seen, mega large buyouts, pan-regionals getting raised, and then you have small mid-markets that are kind of in the market. That's kind of the widening of the market. And I would say if you just look at all the deals that are announced and just look carefully at the pricing that's being paid, you can see there is a very aggressive, healthy upward trend of prices that's being paid for the large assets. So I mean that's just dynamic you have to watch out for. The challenge with being a very mid-market driven portfolio construct is that a strong mid-market manager will always want to scale. So they quickly become a large cap. So you end up having to backfill that, and your sourcing has to be very much on the ground, or you just have to really find those special managers that are committed to the mid-market rather than scaling so quickly.
Yeah, I was going to add the point. So, our ideal candidate in terms of a private equity manager is somebody who maybe has been in Asian private equity, one or two cycles. Maybe they started out as a mid cap fund, they grew large cap, and then a bunch of guys from that firm says, okay, we miss doing these, smaller deals, lower end of the market. That's really where we can generate the outsized returns. Let's come out, start a fund, focus on that, go back to where we were 10 years ago. So, as Amanda pointed out, there's a lot of features of the mid market. This is true of global private equity, where a lot of these might be family owned businesses. They might be smaller businesses that are an orphan within a larger corporate. They might be, a tech company with a great product, but they haven't, built all the systems and processes around how to scale that business. So there's a lot that a private equity manager who can, really work closely with the company, add value to the company, they can bring in and then help the company to grow. And therein is your alpha. So the pricing valuations are a bit more inefficient. There's more scope to negotiate, work closely with the founder to grow the company together. There's also more, frankly, at the exit timing, there's more buyers, potential buyers at the end. So it's a spot that we like very much. But you do need to be careful because there's also, there's the funds that are small for a reason. There's also funds that are small because they're just starting out. They don't have that depth of experience. So as Randy mentioned, the dispersion in the space in terms of returns can be quite wide.
Sure. So there's an interesting question that says, what is the strongest argument in your opinion, and this is for all of you, against investing in Asia? I think it should be more for investing in Asia, I guess.
Against investing?
No, it can't be against. So what would be your argument for investing in Asia?
Return?
I think, I think this is pretty easy. It's we get this question from our clients and LPs all the time. They ask us, "Where's the risk premium?
Yes.
Are you being compensated for the geopolitical risk, the country risk, the currency? I mean, look at how much the rupee has depreciated since the war, right? Are we really being compensated for all of the risks that are associated with investing in emerging markets?" I don't think it's a straightforward answer. I mean, we've looked at the data and we've tried to cut the data to position Asia as favorably as possible. But sometimes it's really hard to make the case and to quantify what the risk premium is for investing in Asia. I mean, the case that we're trying to make is diversification, right?
Yeah.
I think that's the easy way around. That's the easy out that we have is, oh, well, we have to, for a region that accounts for 40% of global GDP, you would be negligible not to incorporate Asia into your global private equity portfolio, right? And that's the case we're trying to make with clients. Whether that resonates with a lot of clients and LPs, I don't know. And I think that, the reality is Asia as a region is still 15 to 20 years behind the US and Europe in terms of private equity. And so we're still kind of in this journey, this evolutionary process. So I do think that there is still a lot of white space ahead, but again, there are a lot of potential pitfalls, and just making that case for a risk premium, I think, is one of the key challenges that we face.
But is geopolitics kind of actually filtering into the portfolio construction decisions today?
I mean, I would just say geopolitics and just global conflicts in general has impacted opportunities globally. I think everybody's feeling a level of pain and and sort of complexity in how they're underwriting their deals, irrespective of if it's Asia only or US or Europe. So I don't think we're unique in that. I think in certain aspect we feel it in, like Randy mentioned, some of the FX currencies, in markets like India and of course maybe even Japan and so forth. Um, but I think just more towards the question of the Asia, why would investors look towards Asia as a block to build exposure to? Well, I mean, simply, if you just look at the very basic facts, 3 out of the 5 largest markets are in this region.
Yeah.
If you look at just the pace of innovation in some of these underlying markets, be it in China, be it in India, or so forth, I mean, it's much more encouraging today than it was 5, 10 years ago. So I think it's not really about the investment opportunity or the size of the outcome. It's just the reliability of the exit window. So I say today, if you look at your China portfolio, you're feeling much better today than you were maybe 18, 24 months ago because the IPO market has opened up. The outcomes are 10 billion, 20 billion, 30 billion of IPO listing that you have in Hong Kong that you simply don't have anywhere else.
Yeah.
Right? So I do think that's exciting. There's a reason to be here and there's a reason to be here early. But it's what we grapple with on the panel and through some of your questions is really just how persistent are the exits.
Yeah. So what do you guys think about China?
Sorry, can I answer the previous
Yes, of
question?
course.
Sorry, I had something. It overlaps with what you guys mentioned already, but then again, 2 thoughts. So one is, why would a global investor not invest in Asia or be against investing in Asia? There's the perception of risk. So whether there's actual risk or not, we'll get to that in a bit. But I think, because I think most of the people in this audience are based here from Asia, so you see what's going on the ground. But if you're sitting in the US and reading only the headlines, there's a lot of misconceptions about what's going on in Asia. And then, is the risk, real? Is it, perceived? There's a lot that's more perception than what's actual reality. And I think for us in Asia, we're also part of global firms. It can be hard to communicate that sometimes. But at the same time, we spend an inordinate amount of time, talking to our research team, investment banking teams, really trying to, the research reports out there will be forecasting maybe 12 months out or so. But we try to talk to our research teams thinking, okay, 3 to 5 years out, impossible to predict 10 years out. How do we think that things will change? What's the policy rationale behind why, there's this, regulation change? So we try to develop a medium-term view. But the reality of it is, we spend a lot of time communicating with our clients in terms of what the actual risk is versus the perceived risk. That's also your opportunity as well, because as I mentioned, there's capital supply, demand, ebbs and flows. Because the perceived risk is high in a certain market, then investors may say, okay, we're not going to invest in this market. But that's actually a pretty interesting time to invest. Amanda pointed out the innovation that's going on.
Yeah.
So China is an obvious one, but we're seeing very interesting innovation from across the region as well. So India, Japan, Australia. So there's a lot going on in the region. And I think we're at a point in time in Asia where, because of this perceived need for a risk premium, is Asia delivering it? Asia's sort of a little bit out of favor, but I also think that's the opportunity as well. So you're getting innovation for a fraction of the valuation, much more capital efficient than what we're seeing in other global markets.
Sure.
I think that's the interesting part of the opportunity for me.
Yeah, I think I provide slightly different perspective. I think what the panelists have said is definitely very valid. I think the other so-called strongest argument against investing in Asia is probably around the fact that, I guess, what Buffett mentioned, the circle of competence, right? You really want to invest in your circle of competence, which is why when you look at the capital base today, obviously a lot of it is coming from US, Europe. The investor in this region naturally be more familiar with the US market and Europe market, and they want to invest in where they know better and where it has generated good returns. Whereas the understanding that they may have about Asia may not be as in-depth as where their home market is, right? So naturally, they would not want to invest in Asia. And I think that's where, I guess, investors who are based here, like yourself and like people here who are covering the Asian market, is, I guess, the right people who you would probably tap on to, I guess, invest in Asia. Just a small point there.
So I think we have time for just one more question. So something very, very basic. If you guys were to build an Asia private market portfolio from scratch today, what is it that you guys would do differently from, say, a decade ago? would like to go first?
Well, for starters, I think we're not the only ones, but I feel like a lot of allocators sitting in this room were likely overweight China 10 to 15 years ago in their private markets portfolio in Asia. Whereas today, their portfolios are probably much more balanced across various Asian markets. Like I mentioned earlier, I think markets like India and Japan have been beneficiaries of this capital rotation, which I do think is a good thing.
Mm-hmm.
And so I think diversification and balance is one. And I think the other is you have to be more intentional about kind of risk segmentation, right? And so when we think about portfolio construction, we break it down into multiple dimensions. Growth, liquidity,
Yeah.
um, opportunistic alpha, and really you're solving really to build various types of exposures, or kind of you're using different markets in Asia to capture these types of opportunities. So where in your portfolio are you building for growth? Where in your portfolio are you building for liquidity and DPI? And so our approach at Stepstone, when we construct private equity portfolios, is very much of a multi-strategy approach where we use fund investments, secondaries, and co-investments. Fund investments to really anchor and seed the program, secondaries to mitigate that J curve and to accelerate DPI and liquidity. And then finally, co-investments to be more selective and intentional in terms of which GPs we want to lean into, and which sectors we want outsized exposure to.
Sure. Amla, Amanda, how would you guys construct the
Very
portfolio?
very similar to what Randy had mentioned in terms of just more selectivity around the thematic and sort of the type of alpha that you're trying to unlock. I think looking back, I think the biggest learning is probably concentrating too much actually. So I think China is one that's obvious, and there's certain different pockets that we also concentrated on. And I think as a house, we always take a view more around buyout versus venture, and I think looking at Asia as a region, as a single broader allocation is certainly not the way forward. So I think for us now looking forward, everybody's very much leaning in towards Japan and India as a market that's really developed in the last couple of years. But I think, back at our internal discussion, it's always been sort of, there needs to be guardrail of how much you're putting in this
Yeah.
market, right? So that you don't end up falling into what had happened a couple years ago with the allocation you had done in China, of course, being the obvious example.
Jonathan?
I think from portfolio construction's perspective, I think naturally you allocate a larger portion of portfolio to a deeper market, right? So just like why US is the largest allocation within the global portfolio. So if you look at 5 years ago, obviously China was that US within Asia, which is why naturally people allocated more capital there. Of course, whatever happened after that, economic policies and stuff changed the dynamic. So I think now it's more diversified portfolio. I think it's hard to say what kind of portfolio construction they should construct. I think, like I say, you should go for the deepest market with the liquidity, which I guess today that within Asia will be countries like Australia or Japan. This is why people are allocating more. I think what we could have changed or do more is maybe in terms of evolving the portfolio, the managers that you have in the portfolio.
Yeah.
Because Asia is a more dynamic market and it's evolving versus a more, say, stable market like US and Europe. So managers who have done well, let's say a decade ago, may not be as relevant today for various reasons, right? Be it strategy, be in terms of whether they're still in touch with the market and stuff. So I think we have seen that in our portfolio where we are investing in a certain manager, but the manager may not be as relevant going forward. So I think the churn of the portfolio should happen more frequently within Asia, just given the evolving dynamic market. So I think that's the part that probably we could have changed or done better.
Sure.
I'm gonna be a bit contrarian. I actually wouldn't change our approach.
You wouldn't?
So I wouldn't. Our approach has been very focused on understanding what's going on in each market, taking a forward point of view. So if I think back to our portfolio from the 15 years I've been here, we did India, 2013, played out very well. We were underweight China last cycle. So at the time I was sitting around thinking, I feel like I'm not doing something right here. But it actually, because we were very uncomfortable with, a lot of money rushing in, high valuations that were probably on par with US venture valuations. So we actually, took a pause, or it was very hard to pull the trigger. So I think by having this, the key in Asia, so I forgot to mention one of the points earlier, why an investor would not invest in Asia is because they've had a bad experience. So that's a very common refrain from those guys who have been in the industry a very long time. They've been burnt in certain markets. But the go forward case in Asia is pretty interesting. So with Asia, you always have to take a forward point of view, think about how the markets will evolve. And I think, we've tried to do that over the 15 years I've been here. I think we've, largely done relatively well. I think the next 15 years is actually a very interesting time because I think the GP, in terms of the manager set, manager quality, the markets in terms of IPOs, what's going on in the markets, all of this innovation that's come out, I think it makes the upmarket opportunity really interesting. So just trying to continue to be forward-looking, do more, if anything. So I think the market opportunity is deepening for sure, and I think there'll be more opportunities.
Great. And I think it's just at the right time. We've covered everything that we'd set out to. Thank you so much. Thank you, everybody.